put a report out overnight after the first half result. Target price reduced 8 cents per share. We're now at $12.54. Stock closed yesterday at $11.33, so there's about 11% potential upside there. FY18 DPS guidance was unchanged at 56 cents. So that's actually implying about 8.7% growth from last year. So that's giving us a forward distribution yield estimate of around about 5%. I think that DPS can grow by about 7% per annum in subsequent years. And it was interesting to hear the CEO yesterday talking about the growth potential within his business. He said, the existing assets in a steady state basis should be able to produce about 6 to 8% growth. Add on development projects, M&A on top of that to sort of deliver a bit more, but also acknowledging that the law of large numbers will eventually catch up with that distribution growth rate. And that's certainly what I've got in my longer term forecast. Just in terms of the first half 18 result, TCL achieved just 1% traffic growth, and that was held back by negative growth on its largest asset, CityLink, which had construction works impacting it. And there was also construction works impacting a number of other assets. But just a testament to their commercial now, even though there's only 1% traffic growth, there was 10% revenue growth coming through the business, 11% EBITDA growth, and that leveraged into about 14% free cash flow growth. So DPS was already disclosed at 28 cents, fully covered by that cash flow. Look, there's some positive and negatives in the result at the asset level, but on an aggregate basis, it was a good result and broadly in line with our forecasts. And I really think it reflects that sort of portfolio benefit coming through from their networks across Melbourne, Sydney, Brisbane, and Virginia. Transurban discussed its committed development portfolio. So it's got about $6.3 billion of capital that's committed to development projects across FY18 to 22. And it also highlighted numerous road opportunities coming up over the rest of this decade into next decade. Obviously, the most imminent is the New South Wales government's sell down of 51% of WestConnex. Unconditional bids are due by mid-year, and surprisingly, it actually views itself as the underdog in this competitive shootout, citing the Spanish company Sintra as also being involved and usually bids very aggressively. And it also highlighted our future potential investment in the USA, in particular naming Maryland as a potential area. So look, after the capital raising late last year, Transurban's credit metrics are very strong and certainly well above what they need for their current credit rating. So it gives us plenty of capacity to fund those growth opportunities without having to come back to the market for further capital. In terms of forecast, changes are quite minimal, hence only the small change to the target price. I'm very comfortable with keeping the ad rating.